Hey option traders, for today's trade we are looking at an option play in the VIX, also known as the CBOE Volatility Index. The VIX is not a stock but a real-time index that represents the market's expectations for near-term price changes of the S&P 500. The most important thing to remember is that the VIX represents the market's expectations for volatility over the coming 30 days. Volatility is a measure of how fast prices change, which is why investors use the VIX to measure the level of risk, fear, or stress in the market when making investment decisions. A spike in the VIX represents an influx of fear in the market. This week, the VIX showed a notable action, spiking from 24 to 34 ahead of key economic events. Today's market is liable to potentially strong volatility as the Federal Reserve is slated to announce a raise in the benchmark borrowing rates by 0.75 percentage point, something it hasn't done in 28 years. Soaring inflation and volatile financial markets has put pressure on the Fed in recent months to hike rates to combat unwanted economic conditions. The decision is due at 2 p.m. Eastern, and Fed Chair Jerome Powell will speak following the results. Between now and then, the market will be nervously awaiting the outcome as volatility remains high. It's also reasonable to expect volatility to drop once the outcome is known. So we're going to look at a trade known as the broken wing butterfly to take advantage of the expected decrease in VIX volatility after today's announcement. A broken wing butterfly with call options consists of a few key components. Remember, with options, there are two types of options, calls and puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. The trade is created when an investor sells two calls at a given strike price, then buys one lower strike call and one higher strike call relative to the two short calls. The higher strike call is going to be further away from the short calls than the lower strike call. Each call in this setup will have the same underlying stock, the same expiration date, and a different strike price except for the two short calls, which will have the same strike. With a broken wing butterfly, you will receive a credit or premium for the trade. These spreads are designed to benefit from decreases in volatility. So, for example, right after a major earnings report or news event, investors can expect to see a drop in volatility, which was heightened leading up to the event. Depending on the option, you could have a number of expiration dates and strike prices to choose from. This is incidentally one of the strengths of options. Options provide choices, and investors can analyze a variety of criteria to determine which best fits their needs of their portfolio. So say we assume that XYZ stock will rise to 45 a share by the expiration of your trade. You'd enter a broken wing butterfly with two short calls with a 45 strike, while buying a lower strike call and a higher strike call around this point. Maybe you choose a lower strike of 40, 5 points below the short strike, and a higher strike of 65, 20 points above the short strike. The spread nets you a total credit of $1. There are two spreads here in this trade. The first is between a long 40 call and short 45 call. This is also known as a debit spread. And the second is between a short 45 call and a long 65 call, and this is known as a credit spread. The wider strike credit spread earns the investor a credit to cover the cost of the narrow strike debit spread. By using calls, you'll make a profit if the underlying drops, and that profit will be equivalent to the credit received up front. This trade can also be done with puts, where you profit if the underlying rises. In that case, you'd be financing your long put spread with a much wider short put spread. The trade using call options will make a profit even if the stock price goes up, as long as it does not exceed the credit spread strikes. You'll earn the biggest profit if the stock moves towards the short call strikes. If the stock moves above the credit spread strikes, you'll end up with a loss. But the good news is that your risk is defined with this strategy, so you know your worst case scenario before entering the trade. If the underlying price stays roughly the same while the stock's implied volatility drops, you'll still earn a profit. or if implied volatility drops while time passes and draws closer to the expiration. So, to summarize, broken wing butterflies require time and volatility contraction to make money. So now that you have a better idea of how to set up this strategy, let's take a look at my trading platform and set up a real-life trade using VIX options. So on my thinkorswim dashboard here, I'm going to first start with the ticker symbol as always, which is VIX. And for the spread type, you can choose butterfly here in this box. You're going to want to make sure you are on the July 20th, 2022 expiration. And I'll go ahead and click one of these to set up the trade below and then adjust the strike prices here. So we're looking to sell 2 45 strike calls, buy 1 40 strike call, and buy another 65 strike call. This will provide a 2.4% return if the VIX stays below 40, with the chance for higher profits if the index is trading between 40 and 50 next month. The recent rally in the VIX from 25 to 35 really boosted the underlying's volatility. Assuming a trader believes that the VIX will continue slightly higher or stay in the same place in the coming weeks, they could look to sell 2 July 20 45 calls, buy a July 20 40 call, and buy another July 20 65 call. This will provide a 2.4% return if the VIX stays below 40, with the chance for higher profits if the index is trading between 40 and 50 next month. The trade meets the criteria of being placed for a credit, with the net credit received of $35. The capital at risk and maximum loss is $1,435. If the VIX stays below 40, all these calls expire worthless and you're left with the $35 gain. There's a large profit zone if the VIX lands between 40 and 50. However, losses can occur if the VIX spikes above 40 in the first week or so of the trade. And the main risk is if the VIX moves above 50. One caveat is that VIX options behave a little differently from stock options, so make sure you understand how they work and you're familiar with them before you're trading them. Broken wing butterfly trades are risky and advanced. While losses are defined, it is still best to practice in a virtual trading account before risking any real capital. Only try the trade with real money if you have a good handle on the risks of the strategy. Always remember that options are complex and investors can lose 100% or more of their investment, so be sure to check out investors.com/options for more option trading tips. And we'll see you next week.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.